Portfolio Builder members, welcome to our Tuesday Trade Alert. Big switch today as we're dumping USO, especially after a speech from Trump today with the United Nations, where he further concreted his views to avoid war and escalation with Iran. They've simply put a ton of sanctions on Iran, so most likely we'll have to sit and wait for Iran to attack back. There's some odd things going on in the markets today, especially in the repo market, which will take some time to look at. And just to sum it up really quickly, let's look at how our portfolio has performed in the past week when you combine the strategies together. So on USO, we did take a loss. This was after we saw the attack on Aramco last weekend. We switched from Facebook to USO, and unfortunately, the escalation did not happen right away, so we've decided to get out of that position. I do like USO if there's a trade deal with China, as now they are talking about buying U.S. oil and gas as part of a deal, so we'll see if anything can come of that. In the meanwhile, money is flooding into the gold and silver markets as something is very funny happening in the banking system, where they're out of cash, and the people who do have cash don't want to lend it to other banks. At the same time, we're seeing the major brokers build up these huge positions in the treasury market and are not willing to sell their treasuries. So we'll take a look at all of this. But overall, in the past week, our portfolio is up $13,074. Now the SPY, since I did create this, has gone down a bit. The SPY is having a hard time getting over that $300 level. So this little piece may be less accurate right now. The TLT is up $2.70 a share on 3,700 shares for a $9,990 profit. And then our USO shares of 13,000 lost $14,450. And then our GDX position is getting a strong bid. This is up more than I'm reporting in this alert right here. But in the past week, it has shot up $1.76, or a profit of $6,784. Net profit week over week is $13,074. Now, this does not include any options we have on the TLT or SPY, so we'll be taking a look at that on Wednesday for the SPY and Thursday for the TLT. But right now, I believe our TLT is at the max profit for the period because of where we sold our call option. I'll just pull up a quick chart. We can see the SPY is having a hard time getting out of this range. TLT is flirting with our max profit at the 143 level. And so what would be ideal for us next Thursday is for the TLT to have a tiny pullback and then for the SPY to pop up a little bit higher. We have 17 people watching us live. Shout out to our regulars, Ernest, John, Tom, Scotty. Thank you so much. Scott, I do want to let you know, because you're a boot camp member, we will be potentially having a few extra training sessions before we officially start. We need to get you ready to take advantage of what I think will be the biggest trade of 2020, which we'll take a closer look at in this presentation. Now, if you're watching live, please say hi in the chat box. We'd love to get to know you. And it's, of course, much more fun if we're interacting together and taking advantage of this very cool technology that YouTube has provided for us. So again, our portfolio is trading Monday through Friday. A very quick trade takes 30 seconds, maybe a couple minutes if you're a little slower. Monday, Wednesday, Friday, we trade the SPY ETF. On Tuesday, it's a hand-selected stock or ETF. This week, we've chosen SLV, which I think we may be playing for a considerable time. We have played it quite a few times in the Tuesday trade alerts alongside Apple. So in the past several months, the only stocks or ETFs we've used in Tuesday trade were USO last week, which was a flop, unfortunately. We traded Facebook for a few weeks before that, and then we did very well with Apple. And in between that, we've used silver ETF SLV. So we're back to SLV, and we'll take a look at all that. Now, if I do zoom in on this, and then Thursday, of course, we're trading the TLT. The Thursday trade has generated the most profit in our total return to date. So with a $1.25 million starting point, this portfolio has generated a profit of $214,000 since the Christmas massacre. Mid-December is when we launched this. And you can see our return has been 1.2% in December, 2.2% in January, 1.7% in February, 2.7% in March, April, May, bouncing around those same returns. Our best return in June. July, we lost 1%, August 1.8%, September 1.5%. So only one losing month of negative 1%. And again, the goal of this program is not to capture large amounts of growth, although you could argue a 17% return is plenty of growth. Our real goal is to generate safe income and to have very little downside risk. To do that, we have to have put options below our big positions, which are the SPY and the TLT, and then we sell call options above for income. Beyond that, we have a small buy and hold portfolio, which is currently targeting GDX, the gold mining ETF. Now, for those of you who are trying to get out of the last week's trade, again, the format's the same every week. Sell to open and buy to open to start it off. So we sold the call, which limits our profit, and we bought the put, which limits our losses. And this is our standard format on our income-generating trade alerts. And to get out of that trade today, you would simply buy to close and sell to close, those same option contracts. And then you would need to be actually an active member to get today's specific trade alert. So just a quick little piece about who we are, and then I'll jump into the most important news of the day and what's going on in the markets. So there's our disclaimer. We have a very high success rate because our trade alerts come out at predictable times and are very simple to follow. Most advisories out there have less than a 10% success rate because the trade alerts are unpredictable. You don't know how much of your capital to allocate, and oftentimes the advisors are a little fishy with their trade alerts. Ours are not. Ours are extremely easy, on-the-go, daily retirement income trade alerts. Dean says it takes 30 seconds. Who's counting? My dad says it takes less time to take out the trash. And I ask you, don't you have better things to do with your time than worry about your portfolio, track hundreds of tickers, and watch countless hours of media every day to keep on track of everything? My promise to you is I will protect your assets and show you how to pick the low-hanging fruit. Put options below our SPY and TLT ETF make it impossible to lose very much money, period. Those two stocks, or rather ETFs, represent 90% of our portfolio approximately. Welcome, Ron. How's it going? Thanks for saying hi. And again, our goal is income and safety, not growth or speculation. Target return on investment is 1% to 2% a month, and we've only had a single losing month of negative 1%. And if you watch this daily YouTube video, you'll know exactly the rhyme and reason of every single trade alert, and I'll boil down 8 hours worth of studying every day into a quick 30-minute YouTube video, so you're up to date on everything. Now, we have several different asset allocation strategies that may make sense for you, depending on your account size and how frequently you want to trade. So if you want to play it as safe as possible, this is your best setup. Requires $66,000 of capital and places 100 shares into the SPY Monday, Wednesday, Friday, 200 shares into the TLT for our Thursday play, and then you would buy and hold about 10% of your total portfolio in GDX. Now that's a big position. I would not recommend such a huge 10% allocation into gold unless we had all the right ingredients, and we do. We'll talk about that in a minute. If you like to get higher returns with more risk, this allocation can potentially provide that. Now, sometimes our Tuesday trade has bigger losses. Sometimes it has bigger gains. Overall, it has outperformed the SPY trades. And if you want to only trade 2 times a week, here's your allocation. 900 shares in SLV to get a value of approximately $15,000 and 100 shares of the TLT to have a similar ratio of bonds. Now, bonds and silver are somewhat correlated, so this is not the same risk profile as the previous screen. And again, that Tuesday stock will change depending on what we think is the best opportunity for that week. And still, a 10% buy and hold in GDX is highly recommended. The best strategy is to follow the Monday through Friday trade alerts and take advantage of all of our information. This would put 100 shares in the SPY for a value of $30,000, 600 shares into SLV for a value of $11,000, and 300 shares into the TLT for a value of $45,000. And yes, another buy and hold 10% position in GDX. So those are your options. If you did not get the actual trade alert today, call Dean 505-322-7515 so we can get you started. Now again, just because we've given you the tickers, what you're not getting in this video are the call options that we're selling for income and the put options we're placing below for protection. And if the market were to have a downturn, we can easily modify our options to profit by holding these assets and simply flipping the options upside down to profit from a down move very safely. So that's not our current outlook, but that could be the outlook in the near future, as there's definitely some trouble in the financial system. Wednesday, 1 p.m. Eastern, we have our paid-only webinar. That's tomorrow. And Thursday, we have a free webinar for all to join. And again, that's on Zoom. Instead of just chatting with me, you can actually talk live. Don't forget to subscribe to the channel and click the bell to get your automatic notification. And I would recommend downloading the YouTube phone app and subscribe to our channel. And that way you can see our daily live stream from your phone on the go. Okay, so one last review. By having this allocation, even though my prediction that the SPY would be popping up this week was incorrect so far, we actually still have a healthy profit, $13,000 profit in a week, and it's by having a smart allocation of capital. So I've got this up there so everybody can look at it one last time, and we'll jump into what's going on in the media. Also, I did link in the email to all of these trade alerts, so if you're skeptical, go ahead and go to your email and you can click and read each trade alert. Okay, so there's those trade alerts. Also, in the description box, we have a lot of links for you. We have links to sign up for a free trial. We have links to register for the webinars. We have links to view the track record, to join our boot camp, to review this document, and to look at all our trade alerts organized per portfolio. Okay, so let's jump into what's going on. S&P falls back below 3,000. Bitcoin and bond yields tumble, and as Trump taunts China at the United Nations. Watch that this morning. Key highlights: he totally bashes China, says that the world thought China would adopt a lot of democratic views over the last 20 years, but instead they've just taken advantage of the world, and goes through the same laundry list that we've heard a million times. Also says he's not going to aggressively attack Iran and instead just doing sanctions. So that's another reason we hopped out of USO today. And really no big surprises there. The same message being pushed forward. The next big topic is that the dollar shortage in the banks remains strong. It had died down for a few days. Again, they're lending out $75 billion overnight to banks from the Fed, and they're also doing a few smaller loans that are 2 weeks. And this is where these banks put up collateral like CLOs or treasuries, and as long as they're liquid, they can get overnight borrowing. Most of this is just to have enough money in the bank to subscribe to the regulations they need to follow. And last night it was oversubscribed substantially. So there's still a huge shortage of dollars in the financial system. And a lot of people were saying perhaps it was because everybody was trying to sell their treasuries, or because the United States Treasury was trying to fill up its budget now that it was approved. And other people were saying it's because of taxes. But what's odd is the primary dealers of treasuries are not selling their treasuries. They're buying them at auction and could immediately flip them in the market for a profit. But instead, they're hanging on to their treasuries. So there's something very odd going on in the markets. And the banks who do have cash are not willing to loan their capital out to other banks for a guaranteed profit. So there's something very funky going on in the banking system that we have to keep a careful eye on. And again, that's why it's so important we have those put options below our core positions. If something were to crack, we're not going to get hurt. Whereas people who are just long their equities, they have a lot to lose. And it could be a dramatic sell-off in just several days or weeks. So here's a little article about the oversubscription for the repo. Bank of America, Goldman Sachs are predicting QE begins November officially, and have even charted out exactly how much they believe will be printed and start soaking up the bond market. Bitcoin's had a crazy flash crash, which is very odd, and apparently the hash rate, which is how fast they can process transactions, dropped in half. So I'm not sure if some major mining facility went down or what exactly it is yet. This news just hit. But this is odd considering that gold and silver are having a bid today. So in no means am I worried about the health of the crypto market, because we have a clear path towards lower interest rates, lots of QE, which is extremely bullish for these. And I also believe China is going to dramatically devalue their currency in the next 6 months, which I think may create the next major financial crisis. And also one of the most profitable potential trades of 2020. There's some articles about that. If you do want to read it, again, the link to this document is in the description box. Meanwhile, a lot of hype over this call to Ukraine from, I believe, 2 years ago, where he was trying to get dirt on Biden and his son. Apparently, Biden's son has taken millions of dollars to work for I believe, a gas company in Ukraine. And meanwhile, Biden's son also has a hedge fund funded by China to the tune of $1 billion. So Biden's chances for presidency continue to plummet, but meanwhile, the impeachment odds have soared to over 56%, at least for a hearing of that just today. So interesting drama in the political world. Meanwhile, Warren seems to have a clear lead for the Democratic Party, which some people have come on and said the stock market won't open if she becomes president. I'm not sure if that's true in terms of a stock crash if she were to immediately become president, but she does have a lot of policies that would certainly scare the rich out of the United States. At this point, I don't think anyone has a chance to outperform Trump in the election, but we will keep a close eye and how that may relate to markets. Here's a look at the PMIs in Germany, tanking down towards 40. Very scary, pushing bond yields lower and bond prices higher. Meanwhile, we're having some conflicting news. We got Trump bullying China at the United Nations, and then we have China actually buying farming goods. They've bought some soybeans, removing tariffs, and now the word is that in 2 weeks, the talks will continue, which is what we were expecting, a period of peace going into their 70th anniversary. There's that bond yield. The yield of the German bond is a good way to indicate the health of China. If Germany is having a hard time, most likely China is as well. We can't trust the data out of China, but we can out of places like South Korea, Germany, and Australia. all very correlated to the health of China. And it's my thought that China will be the Lehman moment. It's going to burst its bubble, devalue its currency, and I think create a global recession in the next several years. If we continue to place pressure on them. Now, if they do come to the table and make all the reforms that the U.S. is demanding, then perhaps they just print a lot of money and work their way out of this. So hard to guess what the Chinese will do. So far, they've clearly kept their feet stubbornly on the ground and done nothing. There's a look at the German Bund 30-year, 10-year chart, or 5-year chart. And you can see it's extremely correlated to the U.S., which makes it relatively easy for us to predict the bond market, which is clearly headed towards lower rates at this point. Look at the key stocks I track. Pretty much everything in the red today, except for really the TLT, getting all the way up to that 143 level. Here's the SPY, which I believe is ready to break towards the 315 level, where I've called it the danger zone. And I believe at that point we will tighten our collar up and stop trying to generate the profit from the SPY going higher, and instead start trying to generate the profits from the options. So I don't want to miss out on a 15 plus potential move. Now, if we do get a farming deal into next month, I think we could actually go substantially higher than that. And why? Well, the rest of the world is really having a hard time. Their PMIs are crashing. Their bonds are in negative. No sound still? Test one. Yeah, I think I got sound. You might need to unmute your mic there, Ron. So there's really nowhere to invest. You can't buy negative yielding bonds. Those are guaranteed to lose money. It's really just big banks buying that as insurance to protect their equity portfolio. But think about it. If you buy a negative yielding bond, someone at the end of the day has to lose on that bond. There's no way around it. So the bond market's really not competing with the SPY. Other equity markets around the world are certainly not competing with the SPY. So everything points to me. And then on top of that, we have QE coming in. So all around the world, not just the United States. It's already begun all over the world. So this points to a much higher stock market if there's no major scare. Now, of course, a big scare can freak out everyone very quickly, and we've seen this market is extremely news sensitive. But because China has their big anniversary starting October 1st, they're having trouble with keeping their populace happy, and food inflation prices, I think we're going to get some sort of interim deal where they buy food and we potentially delay the December 15th tariffs and don't concede on any of the other points, just push it into next year. That's the potential upside for the SPY and why I continue to have a position that allows us to realize the profits of the SPY and simply protect from the downside in case we're wrong. So we're selling that out of the money call to finance a relatively close put that puts our maximum loss around 1% any trading period. So we'll see how this develops. That's my current expectation. It's been happening a little slower. We did get the rebound up to the 300 level as I predicted very quickly, and now it's having trouble bursting through this 300 level where there's a ton of call option writing, which means everybody's holding the SPY is just collecting income right now and would sell their shares at 300, which would put a potential ceiling on it without a catalyst. What I think will happen is people are going to slowly get out of these losing bonds and rotate into stocks as they see the trade war is in a period of peace. Now, I don't think the trade war will be able to completely resolve itself. But meanwhile, our TLT position has been pouring in profits for us and continues to do so. We've had an extremely high accuracy rate. We did call a top on it, at least a short-term top at that 146 level, popped up a few dollars higher, then crashed. We used the options market to sell an in-the-money call option on the TLT to finance an in-the-money put. And this allowed us to have substantial profits by owning the TLT and taking advantage of the option market to generate a profit to the downside. Once it sold off and we got the repo market madness happening, we flipped back to long the TLT and have been enjoying more profits on the TLT. So we'll keep a close eye on that. We'll focus on the plans for this on Thursday. I don't want to spend too much time on it. There was a really good Jeffrey Gundlach interview on CNBC Tuesday, the day before the Fed announcement, where he basically said we got the inverted yield curve. He's expecting a recession by before the election, and the next step to really put the nail in the coffin would be a steepening yield curve. Now, for us to not have to sit there and pull up yield curves every day, simply put, the TLT would need to have a dramatic sell-off to steepen the yield curve, because the TLT represents your long end of the bonds, of the treasury market. So if we saw this starting to really tank, that could be very bearish for the longevity of the stock market. And so if that TLT got towards the level back in October of 2018, where we first saw the stocks really crash, and the 10-year got to about 3% yield, that's where the bonds suddenly become so attractive that money just dumps out of the stocks and flows into the safe haven. So we're carefully looking at that. Right now, TLT is looking healthy. All the credit markets are looking healthy. So the cycle of corporations borrowing money for next to nothing and then buying back their own stocks is not broken. So it's hard to be bearish on stocks when the corporations can simply buy back their own shares for free from the credit market. GDX is the gold miners. I think GLD, the spot price gold, may be stuck in a range for a while as the central banks are simply printing money, lowering rates, and then converting their rather weak currencies into gold, and that's to build confidence in their central bank. So we may see the spot price of gold get stuck at this $1,500 price for a while, but if you look further down the line, who can create new sources of gold? The gold miners. And so GDX is doing very well for us right now and continues to be a hold. Here's a look at the SLV ETF. Now, we're not trying to capture the 276% return exactly that would be achieved if we got back to the 2012 high. However, we are trying to create a nice stream of income from selling call options and buying put options around SLV. And so the headline in today's YouTube video was relative to that 2012. Now you got to remember the amount of money printed to save the markets in 2008 is most likely going to be tiny compared to how much money the world's about to print to try to save itself from a global recession from China crashing. China has been the real growth engine for the world, at least emerging markets, for the last several decades. And I think they're just running out of ammo. They've printed more money and created more debt in the last 10 years than America has in several decades. And in fact, they poured more concrete in the last decade than America has in the last century. It's absolute insanity, complete waste of money. And all of these types of bubbles come to an end at some point. LQD is our investment grade bond ETF. That's your Microsoft, that's your Apple, even GE is in that box for some reason, and Jeffrey Gundlach critiques that. But as long as this chart is at a high level, that means interest rates for these top companies is cheap, and we know what they like to do. They buy back their own stock. Now, a corporation lives forever, so it doesn't really care if it has some drawdown in the short term. Unlike investors who have to plan for a 10 to 20 year maximum horizon. So when you think of it that way, you realize until these credit markets crack, it's going to be very difficult to get a significant pullback in stocks that last for a very significant period of time. So we keep a close eye on that. We're not trading LQD, just using it as a measurement of health of the top end of the SPY ETF. Now you want to look at the middle or bottom half of the SPY, we go to the junk bonds. And the junk bonds appear to be even healthier than the investment grade bonds, which is absolute insanity. So the credit bubble is expanding rapidly right now, and it'll be interesting to see what finally pops these. I believe it will be China devaluing their currency significantly as tariffs rise when they don't agree to the terms the United States is looking for. IWM, Russell 2000, looking strong. If it can bounce out of this level right here and get back towards 173, throw in a farm deal, delay some tariffs, we may have a massive equity rally ahead. That's why I continue to remain so positive on our SPY position, even though it's been a little slow in the last really week since we got that Fed decision to drop rates another 25 basis points. Emerging markets hanging on to a thread. Again, a little pressure the wrong direction, and this could catapult like it did below in 2016. But a lot of money flooding into this ETF. The banks have a great deal of money tied to China and really don't want this trade deal to break down. So I think that's why we see them continuing to try to give life support to emerging markets, even though their PMIs are crashing in the entire area. It makes no sense for them to be loading up on emerging markets right now, especially when we know a trade deal is quite unlikely. There's the German ETF, same story. South Korea looks a little worse. Here's the most important exchange rate in the world, the yuan to the dollar. I believe this is going to pop towards 8 and be the single most profitable trade of 2020 that you can accomplish with the futures market. So this is something we'll be doing in our bootcamp program, as it will be a little more advanced than just stocks options. But as you can see, we do have a period of peace, and it is strengthening its currency as people are expecting at least a small period of peace in the trade talks. Here's the commodities. You can see silver and gold are at these high levels and quite likely to go probably not too much higher on gold spot price right now, but I think silver can start to really run up. There's a major divergence in the return on gold versus silver right now, so a lot of people are anticipating silver to play catch up in the next several weeks and months as we are likely to enter QE. Trade war win for Trump. Apple does move its production of the MacBook Pro to Austin, Texas. Oh man, okay. Here's a correlation that's predicting the PMIs around the world should pick up in the next few months. And this is as we're lowering rates, printing money, trying to stimulate these economies. So if that's the case, we may have a massive equity rally in the cards, especially if we can just simply get a delay in tariffs and some farming good products. Now, we do have Trump repeatedly saying he's not going to accept just an agricultural deal. So trying to predict that's very difficult, and again, why we need to have our assets allocated in a smart manner so that we can do well in almost all circumstances. Life in China is getting harder, and President Xi Jinping should be worried as the country prepares to celebrate 70 years of Communist Party rule on October 1st. Protracted U.S. trade war, protests in the Hong Kong activities getting more violent by the day. That's another concern. Soaring pork prices, Trump also talked about the world expecting China to respect Hong Kong's laws and rights. So some pretty major pokes at China today. But meanwhile, we are seeing China seem to want to create some sort of peace as they have bought some soybeans and are going into this celebratory period. So very interesting time, very critical time to follow the U.S.-China trade relations. Christine Lagarde article, she had allowed a $300 million payment going to the French president after he apparently had left office. And neither of them got in any trouble whatsoever. Big surprise there. And now she's going to be in charge of the ECB. Everybody's expecting she will be very stimulative with, quote-unquote, a bazooka of stimulus. So it does look like we're about to enter a period of massive quantitative easing around the globe in the next several months. And again, mixed messages. We have China wanting to buy some agricultural goods potentially, but will that be enough? All right, guys, that's a wrap for today's presentation. If you have any questions, please leave it in the chat box. We'll stay on for a few more minutes to see if anyone has any questions. If you're ready to upgrade your account or join the boot camp so you don't miss out on our trades for the futures market, to short Chinese currency. We're waiting for Trump to raise the tariffs and escalate the trade war. It's been a pretty predictable reaction. The Chinese, when they calculate what the tariffs will cost, they go recalculate how much to devalue their currency. And in the futures market, every penny that you can predict in the right direction is a 10% return. So the last high on the Chinese currency was 7.2 to the dollar. We're at 7.1 right now. So just to go back to the last high would be 100% gain. But I think if Trump does some of the tariffs we've been talking about, some of his advisors have been talking 50 to 100% tariff rates, they would have to devalue upwards of 7.8, maybe even above 8, which would represent closer to a 900% return from this current price level. So that's a big trade, but you don't want to get caught on the wrong side of it. So we are waiting for that moment in time for Trump to raise the tariffs when he gets upset that China just does not want to convert from a communist socialist system into a democratic free enterprise. And that's just definitely not going to happen. So the time will come. You want to be educated on the futures market, have all your accounts approved, maybe even do a practice trade in and out so that you're ready to pull the trigger. Understand how much of your account you should risk on this trade, not very much, more like 1%. And our goal will be to get a few extra percentage point returns from that. And again, we got to wait for the escalation and then jump on it. So thank you guys so much for your time. Tomorrow we'll be trading the SPY ETF, doing our paid webinar. Thursday we have our free webinar, and we'll be trading the TLT. And meanwhile, I'll be keeping a close eye on Repo Madness. Alexander, hi. Thanks for saying hi. Any questions out there before I end the live stream? Dean says, great update and color, Jason. The repo market is keeping a focus for my eye. Yeah, the whole world has their eye on the repo madness. That's definitely concerning. And I'm keeping a close eye on it as well. All right, guys. Thank you so much for your time. And we'll have a new live stream for you tomorrow, same time.